mind, I'd like to start with you, because I think RISE has probably more than anyone else tried to systematize exactly these questions of, what are you measuring, how are you measuring it, how do you track this sort of impact thing. So what's your framework?
Absolutely. So what may not be recognized or realized by a lot of folks, especially when a large private equity firm like TPG comes in with a large impact investing fund, is how deep we've gone on the measurement side. And I think the integrity with which we've wanted to approach it led us to really have a lot of conversations with a lot of people in the ecosystem who have been doing this work for decades, because this work has been done for decades. But what we ended up wanting to do for ourselves was to take a very evidence-based, data-driven approach. And with the size of our fund, we were able to allocate the resources to do this in partnership with Bridgespan. So effectively, the way that we look at every investment opportunity for the RISE Fund, and the RISE Fund specifically looks to drive social and environmental impacts aligned with the UN Sustainable Development Goals, is to, first of all, link the types of products and services that the companies we may be investing in to third-party academic research to validate, through the research lens, whether positive impact is realized, whether there's no impact that can be measured, whether there's negative impact, and what the nature of that impact is. And then what we try to do is we try to actually quantify that impact. So when we think about something like education interventions, what does that mean in terms of benefit to the individuals receiving that intervention, and what does that mean over their lifetime, for example, in terms of increased earning potential, because they have better, educational outcomes. We do that all across the board, across the different sectors we are working on. And that methodology, number one, allows us to think very critically about the type of impact we're trying to achieve, whether there has been research done to give us some guidelines as to whether these interventions or products or services achieve those outcomes, and then we measure it. And that allows us to have a conversation with management teams, not only about revenues and EBITDA margins and leverage ratios and hitting those milestones, but hitting very concrete milestones on the impact that they're hoping to generate over the life of their companies. And so we can establish a threshold for, does impact occur? How are we going to measure it? How do we manage it? How do we establish whether companies are achieving that impact over time and doing it in a very analytical and data-driven way?
So Bob, an impact investment firm or project or fund that decides to do this sort of thing, that's one thing, but what are the obstacles to other investors using this sort of methodology or deciding that they want to try and incorporate impact into their thinking about investment?
Lack of data.
Lack of data. Lack of data about what?
Lack of data.
Okay, that was quick. I'll move on.
How is that? How is that to move things along?
He's right.
So you're like in the private markets, right? And what's interesting is you see this kind of shift in the public markets, which is the world that I mostly live in, saying, can we somehow transfer the technologies and the methodologies that have been developed in the private markets? And it's really hard. So I read this really interesting article in Science magazine that I found out from Responsible Investor. And it was basically a bunch of scientists trying to think about impact measurement. And it's like probably the first time you've seen an article in a science journal. And they had a pretty simple model, but it was pretty good. They said there's outputs and there's outcomes and then there's impacts. If you think of SASB is kind of the output outcome. And so these are things that the companies are doing they can measure. What you're talking about with impact is these are positive and negative externalities that are being created. And you see the investment community anchoring on the SDGs, and they're all saying, we want to see what the impact is of these big public companies. I had this conversation with a guy at AP7, and we really don't know. I mean, we don't have standards for ESG information to begin with, right? We've got accounting standards and we take it for granted and we wouldn't have the capital markets we have today. So even that baby step hasn't happened. And then when you get to questions of impact, and there's a lack of data, right? Companies aren't reporting it. SASB's trying to get in the 10K. It's not going to happen anytime soon. Big data is coming around, other data providers of alternatives. When you get to impact, what you do, you need data from outside the firm. And that's the tricky bit. right? The company's going to have to go outside its four walls, and it's going to have to get data in the community that it operates in, or sort of looking at it globally if it's an environmental thing. And to be honest, I don't think anybody knows the answer to that.
I'm going to ask Scott to come in here at this point because you are a private sector firm, Prudential Financial, that does do impact investing. I mean, why, first off, and also, what do you do to try and get around this lack of data? How do you measure your impact?
So I guess your first question was why. Prudential was founded as a mutual insurance company to provide burial insurance to the working poor, and that heritage of being a mutual and side of the kind of commitment among employees and management I think you have is part of our heritage. And then, second, we happen to be headquartered in Newark, New Jersey, which was a city that had extreme difficulties in the late 60s and early 70s that were very, very challenging. And, we elected not to move out of the city and try and weather it out. And, I think that's just part of who we are. Maybe to get at the metrics question a little bit, I'll take a little. Let me tell you about our model. We have a foundation at Prudential, but the foundation really is measured in the hundreds of millions of dollars, and it's kind of money in, money out. Whereas we have a $440 billion insurance portfolio backing our liabilities. Most of our liabilities are very long-term, related to pensions and life insurance. So we're a long, high-quality investor that can tolerate illiquidity. And we have a lot of skills in underwriting, mortgages and private lending and what have you. So what we decided to do about a half a dozen years ago was to allocate a very small portion, but a small portion of a $400 billion portfolio ended up being $1 billion to impact investing. And for that part of the portfolio, in many respects, it's kind of simple. Those are backing our liabilities. So I need to be earning a rate of return on those. I need to be earning an adequate return on capital on those investments because they're backing my liabilities. So, in that sense, we've been targeting a 5 or 6% return on a bond and equity portfolio that's doing impact investing. We then leverage a separate team of a dozen people, which is a lot of people for $1 billion to be managing. And those individuals are out working with our partners. In fact, we've worked with two of the partners on the panels on investments in the past. And I would say they're more driving the development of the metrics of whether we're having the impact that we want on those other factors that are developing. But from my perspective as the CIO, if we're not hitting an adequate hurdle rate of return, and we're not aiming for the moon, that's not a really high number, but if we're not delivering those numbers, then I know for sure we're giving money away and we're not earning a return on it.
Is it a different number you're targeting than for your other $399 billion?
Well, I have a different number for everything I target, right? So it depends on rates and spreads, and in the bond market, if I'm putting money out in a traditional private equity fund, I'm going to be looking for a double-digit return. If I'm putting money into floating rate instruments or into mortgages, so it really depends on the asset class.
Well, then maybe a slightly different way to ask the question: It's obviously a risk-return combination. Is it a more flexible or more lax risk-return combination that you're looking at for that billion?
It is. It is. We're not only looking for a high number. We're looking for an adequate number on the bond portfolio. We're actually looking for a consistent spread, and it's a pretty attractive relative return to other bonds. Of course, we've been in a very low rate environment here for a number of years. But in the equity portfolio, I think we take about 20% of that total portfolio, and it's a bigger portion of the equity portfolio. And there's a portion of that that's relatively speculative.
Right.
If you're going to finance the development of new apartments in Newark, New Jersey, that's a relatively, that could be a speculative investment. You're going to have to accept the fact that you're going to have some hits and some misses. And so we think about it, though, in the context of that $1 billion portfolio, with it being 60% fixed income and only a fractional portion of that being really speculative, we think we can deliver a high yield type of return in a low rate environment.
I'm going to want to come back to you and hear how you structure these sorts of deals, but I wanted to ask Deborah, because you mentioned, when I looked at the sorts of things you do, you talk about these sort of mixed blended finance initiatives, and these seem to me to be rather straightforwardly getting around the question that was raised in our first panel about returns. You're accepting that you take a lower return on the first tranche or on the lower risk part, the higher risk part of it, in order that other people can just get ordinary returns while doing good. So talk to us about that.
So the MacArthur Foundation started making what we now call impact investments about 31 years ago, a long time. We've deployed about $500 million over that time, so not a billion, but not a small number. And we maintain a $500 million allocation to the investing activity, and it's a separate unit. We have a dedicated team that I lead, and we have really incredible flexibility to be impact-driven in our work. So we have a different mandate and a different role and different set of constraints than let's say, our colleagues at TPG Rise, where you've got a set of investors that you have to deliver on, or Prudential, where it's backing a pool of liabilities. We're really doing this impact investing to further the reach of our philanthropic impact. And our primary focus is to use it to drive aspects of strategies. For example, climate is a new area for us, and we're going to be building an impact investment portfolio that complements the grant making that we're doing around climate solutions. So first and foremost, you have to have that frame that we're a type of impact investor that strives for what we call the but-for role in our transactions. So we want to be in a transaction where but for our participation and our capital in its particular form, the whole thing doesn't work. Because that in turn allows us to have a lot of additionality, where we can say we helped leverage and bring those other investors in. So that takes us to the blended, what is now being called blended finance, and there's probably about $50 billion of blended finance structures, mostly supported through government dollars in the risk-taking tranche of those funds, something like 167 funds.
So you said you have $500 million, and that's supporting a $50 billion.
So
is that the
in our case, we have a $500 million as our total impact investing allocation, and we've taken in various transactions. We do direct transactions, we invest in funds, and sometimes we take our position in a blended fund. So an example would be the New York City Housing Acquisition Fund, since we're here in New York, which engaged 7 foundations, the City of New York, and originally I think it was almost 24 financial institutions, but there's still 7 financial institutions involved in its second decade, because the fund has done very well and has just been renewed for another 10 years. And what happened was a layer cake, where the City of New York was there in the very first loss position with its money, and then the 7 foundations created a pool. We were $5 million, alongside Rockefeller at $5 million, and then some other foundations at smaller amounts, but a sizable pool. And that together created, with the city money, a loss reserve that could be hit first if there were losses. Well, the truth is, it's over 10 years now. There's like 11,000 apartments that have been financed, and there have been no hits on that loss reserve. So it's just a really simple, straightforward case of using what we call catalytic capital, risk-taking capital that's patient, that's maybe taking a low cost relative to the risk that's involved, really having an outsized leveraging effect. And what I would just say is that when we think about the impact of, let's say, that transaction, we're thinking both about the units of housing that are being generated and that wouldn't have been generated because there was no fund in the marketplace that would do a loan with 130% of loan to value, which is the distinctive feature for a nonprofit real estate developer. It was built specifically for the challenge of nonprofit developers in the New York market. Those units, we don't believe, would have been preserved and improved without this financing vehicle. So that's the but-for piece.
Do you count the rest of the money that came into the fund, like the money that was just seeking, ordinary, straightforward market returns? Do you count them as impact investing too?
Absolutely. So I think when we look back over our 30-year history, we can look at both outputs and outcomes, things like the number of housing units or the number of slots in a child care center that were financed. But we absolutely look at the leverage.
Yeah.
We did a housing initiative over a period of about 15 years with $150 million of our capital. And we estimate that by the time the loans will have matured, and they're maturing now, over $9 billion of permanent capital will have been mobilized. We absolutely look at that as part of the impact, but I think it's important not to see the money as the only, it's nice
Sure.
because it's countable.
Yeah.
But you can't let that be the only thing that
But
you're
it,
measuring.
it is an intellectually satisfying answer to the sort of, is impact investing a real thing? Is it something that, is just bad investing? What you've done is you've made good investing possible that wouldn't have been possible otherwise.
The whole premise of the catalytic part of
Yeah.
the impact investing spectrum is to make other things investable.
Yes.
That wouldn't be by priming them or de-risking them, helping them prove out, helping them scale up, making them ready for others.
But in all fairness, and I think this stuff is great, this is all small beer. Right, it's
Not-
small beer.
Yeah.
The World Bank is out there with this shtick around billions to trillions, 2.5 trillion funding gap, blah, 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 right? To accomplish the SDGs. And that's a problem that hasn't been solved.
Yeah.
How you get to the trillions and
Yeah.
how you tap the public markets, right? And these gigantic corporations which rule the world, and this enormous concentration in the asset management industry. The top 5 have 20% of assets under management, right? And so if you're going to move the needle, and everybody's picking up the term impact because it's a good thing now. We've gone from sustainability to impact. As with sustainability means different things to different people. How you scale it up, I think that's the challenge.
I'm going to
Absolutely
turn to
agree.
you to talk about that, but I realise now that I very naughtily forgot to ask the polling question before we started. This is one of the instructions to me. So in front it says,
Got a
please
bad
ask
moderator.
polling question if you have a chance. So the 4 of these have been looking at that for ages and I didn't notice. Anyway, so our second polling question for the day, has everybody actually managed to get the app? Who has? Okay, it's actually not hard. I did it, and that's how I know it's not hard. The instructions are on the side thing here, on the other slide that keeps cycling. So keep trying. I did it. You can do it too. So the question is, you can't manage what you don't measure. What is needed to create confidence in claims about achieving impact? And your 3 answers, along with other, are independent verification of social impact, an agreed measure of social return on capital, clear evidence that impact leads to above-market financial returns, or you can say other if you want to chicken out. So very good point. There's a lot of money under management. There's a lot of it is managed by the same few people. I don't think we can call what you've done small beer, to be honest. I think that's a little unfair given the leverage that's involved.
I think it's a point really well.
But the billions
British,
to
she's
trillions.
polite.
I'm not British.
You're
I'm
from
Irish.
Chicago.
I'm very
You're
weird.
from Chicago. You can take it. You'll be all right.
You've just massively insulted me by saying I'm British. I'm Irish. Clearly.
I'm going downhill fast here.
Yeah,
This
yeah.
panel
I've
better
my
end
eye
pretty
on
soon.
him.
27 minutes.
Maya, you tell me. So, how can we get like the big money managers into this sort of thing?
I think that in some of the recent even press reports with Larry Finger's BlackRock, Goldman Sachs buying Imprint, et cetera, it's coming and it's happening. And I think what is really important to people who are sitting up here on this stage and many of you in the audience is that measuring impact is hard. It is really, really, really hard. No one can just walk in and say, I'm going to get this done and do this without being extremely thoughtful, because otherwise we muddy the waters. And I think this is a key concern that that we have with the RISE Fund as we built our methodology, because you don't want greenwashing, you don't want disingenuous efforts to do good, and if you're not extremely thoughtful about this work, you can muddy the waters. I think the other thing to underscore, though, as we've all talked about it, and I think this point is not always made enough in our impact investing sort of conferences, is investing is really hard. Just getting financial returns, risk-adjusted market rate financial returns is really, 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 really difficult. And I think that a lot of the times we come up here on stage and we talk about impact investing and the change that we want to make in the world. And even though there's a spectrum of investing, as Deb pointed out, it's really important to think about different forms of capital, the risk that they're willing to take. But if you are going for what I'll call fully market risk-adjusted return, and if you're going for top quartile return, there are very few fund managers or investors in the world who can achieve that. And those of us who are doing this work fundamentally believe that if you are thoughtful and conscientious about ESG factors, that this is something that a few firms like TPG and KKR, just to name some of the private equity players, have really incorporated for years because they believe that caring about all of the ESG factors leads to better returns for the companies, or better outcomes, financial and business performance outcomes for the companies that they're managing. So it's not lip service. There is a core and fundamental belief that if you care about these things, you should have above average results. We're layering now impact onto that, but this is not, it's very difficult to actually achieve these results. You need a tremendous amount of skill across your management teams, across your investor groups, across your employees to really deliver excellent results in the world. And we just have to remember that at the core. Investing is really hard. Impact investing is really harder. Those of us at the bleeding edge have a responsibility to make sure that we are playing to the highest standards possible. And it's hard because it's expensive, but we need to do it.
So I'm going to use my privilege as being the moderator to ask and answer a question. So, I mean, if it actually helps you to get higher returns by thinking of ESG, well, everyone should have been doing it anyway. I mean, that's the sort of the fundamental belief we have in probably a load of nonsense. But anyway, we believe that, you know, the $10 bill isn't lying on the ground because someone else would have already picked it up.
That's right.
You know? So then answering my question, I can imagine some ways in which taking those things into account helps you to avoid, for example, groupthink or being blindsided by political changes or regulatory changes. So if you had been smart enough to be thinking about the environment seriously 20 years ago, you would have been much better placed than a company that wasn't. Yeah. You know, when we will start to worry as much as we are now about climate change. Is that where this magic extra sort of pixie dust comes from?
I'll ask my friend, the professor here, about the data, because I think there is evidence and there is data that supports that those who have really invested in ESG strategies as part of their overall business functioning do outperform in certain circumstances. But I think that it's actually still, even though, you know, those of us in the room think this is very mainstream, it's still a smaller portion. I heard an interesting statistic the other day from a very secret meeting that somebody went to where the CIOs of the biggest pension funds, et cetera, in the US, you know, all meet, and when asked how many of them think about ESG, how many of them think about sustainability, how many of them think about choice of funds that they invest in on that basis, how many of them sort of incorporate this into their own practice, it's still only about 30%. You know, I think 5-10 years ago, it was probably closer to 10%, so the fact that we moved to 30% is better, but until you get those who control capital to really buy in and believe and push. You know, you need both the groundswell from the bottom, you need the groundswell from the top, and then you need data
Bob, so
to
what
validate.
Are the data? Are there data on the sort of returns side of things?
So the empirical evidence on the company side is pretty strong, right?
On the company side, meaning
On
the
the,
company...
for, you know, if a company pays, and if you say material as opposed to sustainability, those things that matter for the sector, you know, there's a lot of evidence. And then people say it's correlation, not causation, blah, blah, blah. But it's pretty good. On the investor side, it's not as clear, you know, because there's methodological problems and there's data problems, which are even more severe. Basically, it's a wash, right? It's like you can't say that it's better, you can't say that it's worse for investors. And part of the problem is just how you kind of define the comparison sets. I think, you know, the 10 to 30%, I'm sure you're right, to go from 30 to 100, so data is important. The bigger issue, it's really a question of ideology and paradigm, right? Because you have sort of financial economics and agency theory that's ruled the world. And to be honest, most finance professors still think this stuff is bullshit, right? It doesn't fit into what they do. So here I am with a PhD in sociology. I'm nobody. I don't know anything, right? I've got cool glasses. That's about it. And I go and talk to the largest asset owners and asset managers in the world because the finance profession doesn't think that this is important. And so until you get the portfolio managers, right, the sector portfolio managers in whatever asset class they're in to believe what you were saying, it's going to stay at 30%. And that's just a question of ideology.
Scott, tell us about how you, as a private sector firm, how you put together an impact deal. Just talk us through one.
you know, we have this team of 12 people that's out networking. As I said, we've invested with two of the other folks here on the stage. So I wouldn't say they're stirring up deals. They're looking at flow and what's going on. We do about 25-30% of what we do locally.
Right.
One of our foundation views is that we want to invest more heavily in the communities where we operate. So we're going to do more in Newark, and we're going to do more in Hartford and Minneapolis, or what have you. So we're very plugged into those communities because that's where we have executives on boards, and
So you just get to hear on the grapevine.
Well, and we know the problems, right? We know the problems are usually housing, education reforms, really a big deal. So the local flow comes through that. We do invest in funds. But then there's other asset classes that start to turn a little more mainstream over time. So there's an element of maybe where it isn't as much small beer as you might think. So, for example, if you run a portfolio like you have that's been operating for the one you referred to in New York, that's put up 11,000 apartments, hasn't had a credit loss, sooner or later people are going to figure that out and it's going to go mainstream. The example I would use from our organization is 20 years ago, charter school reform kind of started happening. And in Newark, we actually made a number of different loans to what we thought were high-performing charter holding companies. And over the years, we found that those are great loans. And because of that, we now see other people, talking to us and bringing money into the space where what for us once was $10 million school reform loans is now a $400 million portfolio, and people are getting comfortable with the asset class. Well, when they do that, the asset class graduates. It graduates out of impact investing, and kind of goes mainstream.
I mean, it's a bit like alternative medicine. As soon as it works, it stops being called alternative.
Well, look, we've done a lot with solar and wind investing. I didn't even refer to that as impact investing. It's just mainstream now.
Yeah. So that must be a big part, actually, of the foundation's work is, providing the proof of concept for sorts of investments.
So I think, again, our type of impact investing, which, sits, I think we feel really strongly that impact investing should not be an all or nothing proposition where, either it's a grant or it's like the world's best commercial investment, because there's actually an enormous space in between. And we love collaborating with Prudential because you guys really understand that spectrum, and each of us takes a place on that spectrum. And there's a lot of impact that'd be lost if we fall into that kind of false binary, where there are investments that may not be profit maximizing, but may be profitable. And that may sound like heresy, but I think even this whole research conversation pushes us a little bit into this all or nothing mentality, because we become very focused on showing that there are no trade-offs. But the truth is, sometimes there are. Because sometimes the market is very difficult to work in. Root capital works with smallholder agriculture in places like the DRC, and it's a very tough market to service. They've come up with something called the efficient impact frontier that I think is very interesting, and we're supporting them to look at how it might be applied to other sectors.
What does it mean? Just unpack
So
that.
it is an analytical framework, because there's basically, if the research and data is scant on the public markets,
right,
there is no data and research on the catalytic capital piece.
Yeah.
Right? We have some case studies and things like that. There's some studies of blended finance. But what Root Capital is trying to come up with is fundamentally a way to think about the relationship between risk, return, and impact, and sort of, riffing off of the efficient frontier, come up with a way for them to analyze the different kinds of loans that are in their portfolio, and to look at things like the additionality that each of the loan brings. So is this a loan that would have been made by a commercial player, or was this truly something that but for Root Capital wouldn't happen? And that gets a higher impact score, if you will. It looks at the kinds of people that are being served. It looks at the size, the magnitude of the impact, and it allows them to see if they are making trade-offs, which they are in some cases. The costs of servicing some of these loans are not enough to support the costs of servicing the financing that they have. But it makes them eyes wide open, makes them able to see it, makes them able to do deliberate decision making. And so we think the thing is not to prove that there are never trade-offs, but to understand
when there are,
what are the drivers, and what are some of the things that can make them worthwhile. And one of them can be the leverage, and one of the things that we look for can be the sort of long-term systemic impact that Scott was referring to. We think about not just others coming and replicating and mainstreaming, which does happen, but we also think about institution building. So I give you just one other example. There's an organization in North Carolina called the Center for Community Self-Help. And that organization began in the 1980s, and they created a credit union, and they were financing low-income, low-wealth workers who didn't have ways to get home mortgages or to get safe banking products or any of that. We made an investment in 1988. It was $1 million. The organization didn't even have 10 million under management, so it was a pretty high rate. It was small beer, but a big bet. That organization today manages about $3 billion of assets. It is the largest of the community development financial institutions in the country. It is an incredible credit union serving tens of thousands of people. It has specialty products for immigrant customers from many different countries. And it is taking on really tough challenges. Like in our own hometown of Chicago, they have acquired a bank right after the financial crisis that serves the Latino community and had a remarkable turnaround, keeping the vast majority of homeowners who had mortgages in their homes through very high-touch workouts. And they've now acquired a bank that failed last year that had served the African-American community for 50 years. And they're providing banking products that are just simply not available in those markets. They're financing churches. They're doing used car loans, which are essential for low-income people, but usually only available through a high-cost dealer loan. And they are growing like crazy. They need low-cost capital to do their work. The math of what they do doesn't work if they had to pay 15% on their equity. They're not going to be, I don't think, taken out. Pieces of what they do might get taken out by mainstream players. But the reality is we're investing in an institution that innovates, that has voice in the policy realm, that can collaborate with the private sector, working with Bank of America, I know is an important partner. That's impact too, building an institution that has durability and that has an outsized footprint.
So a question has come in from one of the many geniuses in the room who are able to download the app. Well done, whoever.
The 3 people that could download the app.
No, I did it. I tell you. So how would risk return targets in the impact investing space change should the broader market/risk return environment worsen? So would the long-term, and this is the point of the question, is a really good one, would the long-term non-cyclical nature of the impact investments support stability of the risk return profile? So I think this is another sort of theoretical suggestion about how there's sort of pixie dust in impact investing, although your point is very well taken that sometimes there are trade-offs. Any of you like to take this one?
Sure. So since I don't manage money like the rest of these people, I can have whatever asinine opinion I want, right? And I'm not going to be held responsible for it. I can say whatever I want. So I think the answer is yes. And it reminds me of an organization that I'm going to pitch, the Investment Integration Project. Has anybody heard about that, Tip? So it was started by 2 buddies of mine. But what they're doing, they're saying, look, first, we learned how to pick stocks. Then there was, modern portfolio theory. And now there's system-level issues. So if you can take this all to scale, what is the system level? So if you had impact investing at the system level, and you're thinking about the whole system, the financial system, the environmental system, the social system. And so they've started this organization, and they've got a database of 100 asset owners and asset managers. And if you think about it, right, the really big asset managers with all the money in passive, they're in this for the long term. So if the world goes to hell, they're not going to get the returns, right? Same thing with the big pension funds. I got long-tailed liabilities. So they need to think at the system level. And so they've developed this kind of perspective on how these key players can basically make this come about for this reason. So I think it's a great question.
Through the business cycle.
If they think through the business cycle and they think about not just their portfolios, but they think about the impact that they're having at a system level. So, just Google the Investment Integration Project, and I think you'll find it interesting.
Great. I'm going to take some questions from the floor. What I'll do is I'll take a couple, and then we can kind of pick and choose who answers what. I have a hand up here, and I have a hand up at the back. And I have a hand up over here. So I'll take those 3 questions.
I'm David Bohegan with the Overseas Private Investment Corporation that does impact investing in emerging markets around the world. And I'm interested when we talk about the billions to trillions journey, and what are the attributes of a product that the panel thinks would be important to catalyze that? And obviously for anybody else afterwards, that's what we're working on at the U.S. government, so could use your help. Thanks.
Great. Okay, billions to trillions. There was one, yep, great.
Thank you. Matt Christensen with Active Asset Managers. I was intrigued by this idea that Scott shared about graduation. And I'm thinking maybe our female panelists, since you in a way are representing a piece of your organization, is it viewed as something that might graduate to other parts? So if we look at TPG, is RISE something that would be an example that might graduate to Bonderman saying, we're going to do this in all of TPG? And conversely, at MacArthur, is the impact work you're doing something that the ESG style of the endowment of MacArthur's foundation would become something that is just a natural part of the flow of what would be done?
Thank you. And there was one more hand up over here. This gentleman here.
Good afternoon. Andy Sewell, Colonial Consulting. We're investment advisors to leading foundations and endowments. Just quick statement, then I got a question. If institutional capital declares victory and our world is not a better place, I think it would be kind of tragic for this space. I've just been hearing about this person getting into the game, this person getting into the game, and that shows some type of excitement. I think we should probably pat our backs when we can go to Shanghai and probably breathe. We could probably pat our backs when we can stabilize communities, but I just thought I would challenge the notion that we just have to get more capital in impact investing. Question, perhaps for Deborah, the impact banker, is from a foundation standpoint, how do you determine which problems can be solved by a mission-related investment and which problems are better to be solved another way? Because oftentimes we tend to believe that these types of investments can solve every problem, which tends to create other problems. Someone's drowning, you can't structure an investment, you just got to help them. So just kind of curious, how do you look at that?
Great, thank you. So we have 3 really interesting questions there. The billions to trillions, could it be that you graduate to your broader organizations? And Deborah, why don't you start with the specific question that was directed to you, which is, how do you decide which problems are suitable to answer?
I think it's a great question because our goal and our dream is always to crowd in other capital, to be this but-for piece that de-risks or lowers the overall cost of the transaction or somehow makes it workable. But the real risk that we have is we're crowding out, right? The risk is that we're making an investment that at a cost that's too low for what the actual market would bear. And I think the only answer to how we judge that is case by case and a lot of due diligence and really trying to look at the marketplace and to understand, is this a product? Is this something that can be done on terms that the market or other players in the market, and this is not just the commercial players, there may be an existing intermediary or fund that could support the transaction. So we do that analysis on a case by case basis. And then I think, well, let me leave it at that because of the other questions, and I'm happy to speak further with you.
On the billions to trillions question, who'd like to take that one?
I can take a stab at that. So on the billions to trillions, I think there are 2 points I'd like to share. One is that to get institutional capital or the capital markets in, and that constitutes the trillions, you have to understand how decisions are made and how they think. And I think that one of the learnings that I've had is that even though in the realm of impact investing and beyond, you might think that longer term structures, unique structures may be better for the investing itself. When you go and you approach, a mainstream investor, they want a 10-year +2 fund. They don't want a 15-year fund because that's not market. And I think that this is an important thing to realize, that we have to understand how capital is allocated, what the incentives and motivations and parameters are for those who allocate capital, and for better or for worse, while on the side we're trying to be subversive about changing behavior, which I think is better for long-term investing generally, you still have a box that you have to fit in, and you have to navigate those worlds. I think in terms of bridging to this going mainstream, I think that what we have to do is present evidence for how our investing does generate, some of these premium returns, and that's proof in the pudding for private equity firms, let's say like TPG or Bain, that have impact funds, to start incorporating more of the methodology. And again, in our examples, ESG is applied throughout TPG. It's not just applied to the RISE fund. It pre-existed the RISE fund, and there was a fundamental understanding of the benefits of thinking through this lens. But people had to understand and appreciate the benefits, and they're not going to take it at lip service. They want data, they want evidence, and I think that's therefore an important piece of work that we all have to work towards: credible evidence that this, the lenses with which we invest matter from a financial performance perspective.
Could I add 3 quick things to this?
Yep.
So, and I'll be quick. Your world and my world don't understand each other. I mean, when I talk to the multilateral development banks, it's like, I don't get these people, right?
Yeah.
They don't get me, right? What the big asset allocators will say is there's no pipeline. We want to put our money out in big chunks. There's no pipeline. So you've got to bring us the pipeline.
Yeah.
And what I'm beginning to sense is that the asset allocators are saying, if you don't involve us in the beginning structuring, while all the engineering stuff is being done, the public policy stuff is being done, if the financial structuring isn't baked in the beginning, it's never going to work.
Do you want to come in at all on the graduating to the rest of the organisation, either Scott or Deborah?
You want to start?
What has the rest of the organisation learned from the billion that you invest in this particular way?
Well, maybe a couple things. One, because we're a long-term bond investor, generally, ESG, the governance, we're only trying to earn a bond spread and a return. We can't take a lot of losses, and so we expect good governance, and we have. So I think there's an element of that that's sort of built into the kind of underwriting we do. Fundamentally, when I'm making an allocation, I'm trying to hedge liabilities, and so, I think we won't, graduate from, billions to trillions. We might be able to get a bigger allocation of $1 billion to $2 billion, but we'll always, be playing there. I guess if I were to put on, think about an area of hope, I can imagine a world where you look out 10 or 15 years from now, if we're really successful in developing good metrics and in showing that there's an asset class here where you can earn a good return while doing good. I could see individuals being willing, think about it on a 401k platform or what have you, being willing to allocate 5 or 10% of what they do to something where they're probably expecting a little more vol and maybe not getting fully paid for that, but they're expecting to earn a return. I could see people doing that, and those numbers can add up.
Deborah?
Yeah, so we've really made a decision, and every foundation that approaches impact investing has to make its own decision about how to do it. We've really decided that for us, the optimal approach is to carve out a chunk of the assets of the foundation, in this case, $500 million out of a roughly $6 billion corpus, and to really firmly plant that on the program side of the house. It's a resource that we use to amplify the reach and impact of our programs, and it's also now a resource that we use to try to help solve problems and build strength in the impact investing market. So we are completely impact driven in our approach. It isn't to say that we're not financially disciplined, because we don't think it would be appropriate to use the tool unless we were doing it in a rigorous way. And just as a data point, for the investments originated in the 17 years that I've been leading the team, we've had losses, and they've totaled 5%. And if you saw what we were investing in or loaning to and doing unsecured, 10-year loans and working in tough markets, that's actually a result we're quite proud of, in fact. But we're able to do things because of the way that we've set up our approach. We're able to take on risk and put time in and be high touch and help really craft transactions. I mean, one of the ones that we've done with Prudential was for the Housing Partnership Equity Trust, which is the country's first and only nonprofit-led affordable housing REIT. And if you want to know more about it, there's a key person from the operation here in the room. That REIT came together after much more than a year of work figuring out how to put this joint venture together with about 14 different partners, figuring out that the REIT would be the structure, layering the capital. We did a piece that became common equity. Prudential is in the preferred equity. There are senior there were senior lenders in the structure as well. That kind of making of an impact investment. I've said before, they're not just found, they're not like the $10 bill, right? That kind of investment has to be made and crafted. And that's an enormous amount of work and effort. And it would make no sense, none, for our investments team to be doing something like that. I mean, that would really run counter to what their objective is, which is to make sure that we have a steady flow of capital that is stable for our grantees. So we're happy with the approach that we're taking. But what I think it means is that there's this migration that people think about is unlikely to occur.